So I want to just explain candlestick chart. So after you learn candlestick chart, the next you need to learn is market structure. Then I'll expose you to how I trade. So this candlestick chart originated in Japan over 100 years ago, and that's what is used in today's in the modern trading. So develop the bar and point figure chart. So Japanese man named Homer discovered the candlestick chart. So um so the man was a rice merchant. So he realized that there is a link between the supply and demand of a commodity and the emotions of the people trading that commodity. So with that concept, a candlestick, the same the same that with that same concept, candlestick shows the emotion of the market, if that makes any sense. So what I'm trying to explain to you is the man, let me read it and explain it again. To a Japanese man, Homer discovered that why why there was a link between price and supply and demand of rice. The markets were strongly influenced by emotions of traders. So candlestick shows the emotions by visually representing the size of price movement with different colors. Traders use candlesticks to make trading decisions based on regularly occurring pattern that help forecast short-term market direction. So here are the basics of candlestick. So just the way. So he just um so he he invented the relationship between the supply and demand of a commodity, which at that time was rice, and the um which are supply and demand of commodity, which is influenced by the emotions of traders. So what candlestick shows is the price of um the sentiment or the emotion around the price of the market. So I'll just show you what I mean. Normally, when in the market we have the buyers and the sellers. That is the basic thing in the market. So just like buyers chart, the daily candlestick shows that the market open. So just like a bar chart, a daily candlestick shows the market open, high, low, close price for the day. So let me just explain to you what candlestick are. So candlestick shows two things. It shows it's just like a graph. It shows the price of a commodity versus the time look of the time that commodity was traded. So every candlestick in a price chart is showing the like this is the main thing we're talking about right now. So every candlestick in a price chart is showing the price of a commodity and that particular time that that event happened. So if this is a candlestick, sometimes black shows bullish, white shows bearish, and so on and so forth. I normally use color. I use red for bearish and green for bullish. So traders can alter these colors in their trading platform. For example, a down candle is often shaded red instead of black, an up candle shaded green instead of white. So I use color green and red. So basic candlestick patterns. So you have to understand these candlestick patterns so you understand what traders are, what happened in that market, what traders did in that market. You understand? So if the candlestick is small like this, now um the there was no much price movement in the market. If it's now colored green, let me show you what I'm let me check what I'm showing you. So if the candlestick is something like this, you know that there was not much price movement in the market. If you show the colored green, you know that it ended up with more buyers in that market. If it's something that is red like this, that is big, like you say, there are more sellers in the market, and you can see that it's even bigger than the small one that is beside you. You know that the sellers overpower the buyers in that market. You understand? But when you're trading this kind of candlestick together, you should consider them more on key levels. So if I see this kind of candlestick now, I'll believe that at a particular key level, I believe that this market is likely to sell, and I'll be looking for selling opportunities for it to go down. You understand? So what I was trying to explain to you, if you see a big candle like this, now this is a bullish candle that is green, also bullish. You know that the buying pressure is strong. You cannot be selling against this buying pressure. Instead, you even be looking for buying opportunity. But does not mean when something is going up, you'll be looking for buying opportunity. You have to make sure that you're not buying very late when people are already trying to sell and take their profit, because that is when people will be selling. Bearish candle start, maybe that means you're already buying late. So that is it. Um, that is just what is there, sha. So we have different kind of patterns, candlestick patterns, and I'll not use this book to explain to you, to explain candlestick to you. So I'll come back to candlestick. Well, let's go to trading terms. So I've talked about based on cold currencies. So is a pair of currency. You understand? The first one is the base. The second one is the quote. So there are pair of currencies that are being traded. A pip. Now, what is a pip? A pip is a base point or the smallest measure of a change of a currency. For example, in the US base pairs, it is represented by 1 over 100 of a cent. So a pip is 1 over 100 of a cent. With time, you understand what a pip is. But it's just a smallest measure of the change of the currency. So for example, um if is if you're talking about naira, you're talking about the smallest change can be what? Kobo. You understand? So let's just leave it like that. It's just a change. So if something went 100 pips now, that was a high movement, high change in the market price. So a spread is different between ask and bid and ask price. I told you in the last video. So when you bid, you are what? What did I say is bid? When you bid, you are what? You are buying, and when you ask, you are selling. The bid price is always greater than the ask price. So I told you the ask price is what? The amount an investor is willing to what? Sell. Why I told you the bid price is the amount an investor is willing to what? Buy. Let me confirm what I told you. So let's see. Bid price, bid price, bid price, bid price. Yes, the bid price. So the bid price is the amount the investor is willing to what? Buy or pay. The ask price is the amount the investor is willing to what? Sell. So I got it. So we'll talk about stop loss. Talk about some trading terms. So lots of trading terms. Which one did I talk about? Okay, pip. So spread is different between this bid and ask price. So hedging, ability to hold long and short position at the same time. I don't normally use that term lot. This is very important. important stuffs here is this quote and base currency, a pip spread is important. I don't mind use hedging. Lot is also very important. So study them. So don't take everything. I just still do understand what they mean by yourself. So a lot standard unit of transaction. So we transact with what lot size in the market. So usually this equal to 100,000 units. So one lot size is equal to what 100,000 units of the base currency. So there is a mini lot which is 10,000 units and a micro lot of 1,000 units of currency. So when you are buying with a small amount, you buy a micro lot and so on. Just do your research on lot size. So if you keep a position open for more than 1 day, you would have to pay or receive an interest depending on the currency pair you are trading. The rollover price represents the interest rates difference between the two currencies involved. Leverage also very important. Is used by various financial instruments, borrowed capital such as margin. Exactly. So if you are trading with $10, of course, $10 cannot give you any amount. Like and okay, $10. You are trading with $10, for example. If you are risking $10, if you are trading with $10 to speculate the price of a commodity, you won't be making much. But by the time you use a broker's leverage, so that's where leverage comes in. A broker can leverage you. They can borrow you like 1,000 or $100, something like that. So um it makes your $10 to be like $1,000. So when you are buying or selling a commodity, you make a better profit. So I'm not really an expert in explaining those things. You understand? But these are the things you really need to know. Once, like, you need to really understand, because you need to really understand those things. So I commend you to go and watch video or ask AI to explain each of these things to you if you are really serious. Try to explain each of these things to you. Then long. So I'm going long. It means it's just a word like means buying. You are buying a stock. You are buying. So say I'm going short on this pair. That means you are selling that pair. So margin call is when your money finish. The broker demand an investor using a margin to deposit additional money so that to maintain the position you are in. If not, um, the position will be closed. That is when the market goes against you. Support and resistance. I'll explain all those ones. Let me not use this one. Another thing I need to explain to you is what? Stop loss. These are just some important things you need to know about. This moving average is also important. Three moving average. We have simple moving average. I don't normally use it, but it's very important. I'll show you in the chat um when I'm explaining indicators to you. So that one should just be there. So we have risk management, stop loss, very important. So when you are buying an asset or you're selling an asset, you need to set a stop loss so you don't lose money. Like, you don't lose more than that amount you add as your stop loss. If you don't add a stop loss, you're telling the broker that you are risking all the amount in your account and you don't want to do that. So risk to reward ratio, this is another thing that is really important. So you just see, let me tell you, you just read all these things, read them. If you don't understand, ask AI. But risk to reward ratio, you just say, oh, I'm risking this to gain this. So let me just show you the charts now. So currently this is my chart, and wow, this is what I want to see. This is my chart now. I'll be looking to sell this pair. It has broken the trend line, so I'll wait for a retest, then I'll enter the market, and I'll show you the profit I'll make on this trade. So 2 hour chart is really the boss. Is really the boss. Is the boss. 2 hours. Yes. If I enter this trade here, I would have been up by some money now. I'll still enter, sha. Enter by 5. So what do I want to show you? Stop loss. Okay. So here's a stop loss. Rectangle. Fibonacci. I don't know if there's stop loss. Stop loss. That's I'll show you that one in trading view. I don't know what I want to show you. Okay, I want to show you risk to reward. So let's say, for example, I wanted to sell this commodity here. I'll say, okay, if I wanted to sell after this red candle is formed, and let me say I want to sell after this red candle. Let me say I want to sell at the break of this. Let me check something. There's no need to use that one to explain. Okay, I can explain with anything. So let's say I wanted to sell at after this red candle here. So how much am I willing to risk? I'll say, okay, if I'm selling at this point, I want to risk this. This is the amount of pips I want to use. This is about 130 pips. You understand? And I want to gain this. These are risks to reward work. If you are risking this to gain this, so you are risking 130 to gain how much? 350. Risking 130 pips. So you are risking 0.38% to gain how much? 350. So that is how risk reward is. So you don't want to risk this to gain this. It's going to be a bad trade. If you lose for this one, even if you win once and you lose 3 times, your account will still be active. So that's how it is. I can show you. I'll show you that in later. It Let me show you. Let me show you with trading view. So trading view is another one you use to analyze. So trading view is what is like still the same. I trade only one pair. So can see it's the same chart. So let me go to that 50 minutes and still show you the same thing. Let me use 10 minutes. So let's say short position. So let's say enter the trade here. I want to risk here to gain here. I get it. So let's say if you even want to test kind of trade, we'll come to 4-hour structure to find out how much we are what. I need to move 4-hour structure. So well, what I'm going to the risk is the red one. For the reward is the what going on. This is for what sell. For buy. Oh god, mistake. Understand? For let me delete this stuff. So this for the risk. So we want to gain, we'll do it like this. Then we are gaining what? We are risking 286 points. We are gaining 1871 points. So if it's my lot size I normally use like 0.025 times. If you risk 286, you're risking $7 to gain how many is that? 1871. 1871 70 times 0.025. So you risk $7 to get $46. So by the time you enter, like maybe you do 46 divided by 7, no, not times, divided by 7, see that you're getting 6 times your money. So by the time you always get 6 times your money, let me call it 5 times your money. So if you enter 5 trades, you win 5 and lose 5. So if you say 5 times, I'm saying you're risking $5 to get $25. So if you enter 5 trades with $25 win, it be like 25 times 5 trades, you may want $25. So you lost 5 trades with $5. So it will be 5 times 5. So you're still in profit. So even if you win only 4 trades, so 4 times $5 is $20. No, 25 times 4 is how much? $100. And you risk $5 times 6, 30. You're still in profit. So that's why your reward should be more than your risk. So our next class, we're just going to we're going to candlestick charts, candlestick patterns. So that I'll teach you next. Thank you.